Ah, homeownership in India. The ultimate adulting badge. You picture it, don't you? A charming little flat, maybe a slightly aggressive housing society, a yard you can passive-aggressively sweep at 7 a.m. on a Saturday. It's the dream. Or is it? Because this dream usually starts with a home loan. That word, home loan, sounds so sophisticated, almost reassuring. But it's a financial burden. It's the most common way people buy homes in India. Because who has crores of rupees just lying around? Not me. Probably not you either, unless you're a tech billionaire. So we troop off to the bank, like lambs to the, bank, hoping they'll bless us with a massive loan. A loan that will hang over our heads for the next, 20 years. 20 years of diligently paying back a sum so large, it could probably fund a small nation for a week. It's a commitment, like marriage, but with more paperwork. And why do we do this? For the stability, for the investment, for a place to finally put up that hideous wallpaper your partner loves. The allure is strong, I get it. Owning a piece of the planet. But the path there through the home loan maze is often less dreamy and more wake me up from this nightmare. So what is this magical mortgage in India? Basically, it's a giant loan. A really, really giant loan. The bank gives you a pile of cash, enough to buy a house or a very fancy shed. You promise to pay it back, with interest. Lots and lots of interest. It's like borrowing a tenner from a mate, if that mate was a shark. How does it work in India? Simple yet terrifying. The bank, in its infinite generosity, lends you, say, 20 lakh rupees. You buy your box, your lovely overpriced box. Then every month for decades you send them money, a slice of your soul. Part of it pays down the loan, the principal. The other larger part is often the interest. Fun! Think of it like this. You want a cake, a very expensive cake. The bank buys you the cake, but you can only eat it crumb by crumb. And for every crumb you eat, you have to give the bank 2 crumbs for 30 years. Enjoy the cake. That, in a nutshell, is a mortgage. And here's the kicker. The house itself is the collateral. Fancy word, right? It means if you stop paying, if you miss too many of those soul slices, the bank can take your house. Yes, they turf you out, sell your home, and probably use the profit to buy a bigger cake. It's a wonderfully balanced system if you're a bank. Now, not all mortgages are created equal. Oh no, that would be too simple. Banks in India offer a delightful menu, a confusing, anxiety-inducing menu. First up, the fixed-rate home loan. This one is the plain vanilla, the missionary position of loans. Your interest rate stays the same. For a set period, maybe 2, 5, or 10 years, or even the whole term. Predictable, boring, safe-ish. Then there's its wild cousin, the floating-rate home loan, or adjustable-rate home loan if you prefer. With this bad boy, your interest rate can change. It wiggles up and down with the market, or with whatever the bank's Mystic Meg department predicts. 1 month you're fine, the next you're eating instant noodles. It's like financial Russian roulette, but with your house. Thrilling if you enjoy constant, low-level panic. And let's not forget the interest-only home loan. This one sounds great, doesn't it? Interest only. For a while you only pay the interest, not the actual loan amount, just the bank's profit. So your monthly payments are lower. Hooray! But the huge loan amount, still there, looming, like a very patient, very large vulture. At the end of the term, you owe the whole original whack. There are other exotic beasts too. Balance transfer home loans, top-up home loans, home construction loans, each with its own special way to baffle and confuse you. It's a deliberately complex system, designed, it seems, to make you just give up and sign whatever they put in front of you. Just give me the keys. I can't take any more pie charts. That's what they want. Don't let them win. Or do. I'm not your dad. Interest rates. Those 2 little words. They can make or break your mortgage, and your sanity, and your ability to afford basic groceries. So what are they exactly? It's the price of borrowing money. The bank's fee for letting you play house with their enormous pile of cash. A percentage of the loan added on top. Repeatedly. What makes these rates go up and down? Oh, a delightful cocktail of things. The Reserve Bank of India's base rate, for one. If they hike their rate, your mortgage often follows, like a slightly unwelcome puppy. Inflation is another big one. If the price of everything is soaring, so will the cost of borrowing money. It's a party. Your own financial situation matters too, of course. Your credit score, that magical number. It tells banks if you're a good risk, or if you're more like that uncle who borrows a fiver and is never seen again. Got a great score? Lower rates maybe? Got a score that looks like your phone number after a bad night? Prepare for some eye-watering interest. It's wonderfully fair, isn't it? And then there's the market, the mystical, unknowable market. Competition between lenders, global economic conditions, the migratory patterns of Canadian geese, probably. It all feeds into this complex algorithm that spits out a number designed to extract the maximum amount of money from you without causing an actual riot. Usually. So yes, it's a roller coaster, and you're strapped in for decades. Section 5. Admin fees and other financial ninjas hiding in your contract. You've chosen your mortgage. You think you know the cost. You've budgeted. You've cut back on avocados. You're ready. Or so you think. But wait, there's more. Welcome to the wonderful world of hidden fees. Or as banks in India like to call them, standard charges, which is like calling a kick in the shins standard interaction. These little ninjas can add locks to your loan. First up, the processing fee. This is a fee for, well, processing the mortgage. For the bank doing its job, it can be a flat fee or a percentage of the loan. Sometimes you can add it to the mortgage, so you pay interest on the fee for processing the loan. It's feeception, a fee within a fee. My head hurts already. Then there are valuation fees. The bank needs to check if the house you're buying is actually worth the money they're lending you. Fair enough, I suppose, but you pay for it. And booking fees to secure a particular mortgage deal, like booking a concert ticket, but instead of seeing Arijit Singh, you get 20 years of debt. What a show. And don't forget prepayment charges, punished for paying it back too soon, and electronic transfer fees for sending money electronically, which costs them, what, half a rupee? But they'll charge you 500 rupees, mortgage account fees, just for having the account, legal fees, surveyor fees, stamp duty, if you're unlucky. The list goes on. It's death by 1,000 paper cuts, each one small, but together they bleed you dry. Always read the fine print, with a lawyer and a stiff drink, or several stiff drinks. Section 6. Why your banker drives a nicer car than you. Ever wondered how banks in India make money? It's not by giving out free pens, I can tell you that. One of their biggest cash cows? Home loans. Your dream of a little cottage with a rose garden? That's funding their CEO's third holiday home, in a place where roses probably grow themselves. It's a beautifully simple system, really. For them, anyway. Not so much for you. The main way is through interest, obviously. That percentage we talked about? Over 25 or 30 years, the amount of interest you pay can be almost as much as the loan itself. Sometimes even more. Yes, you heard that right. You borrow 15 lakh rupees. You could pay back nearly 30 lakh rupees. The extra 15 lakh rupees, pure profit for the bank, Kerching. New yacht for Mr. Banker. But it's not just the interest on the main loan, it's all those lovely fees we just discussed. Processing fees, legal fees, prepayment penalties. Each one is a little sprinkle of extra profit. Like gold dust if gold dust was made of your tears. They also make money by selling on your mortgage. Yes, they bundle up thousands of mortgages and sell them to other investors. It's called securitization. And sometimes banks lend money they don't strictly have. It's called fractional reserve banking. It's complicated. And frankly, a bit terrifying. The point is they are very, very good at making money from money, especially your money, or the money they lent you. So next time you see your bank manager's shiny car, remember, you probably helped pay for the hubcaps, and the leather seats, and the private school fees for their kids. Section 7. The not-so-fun house risks and nightmares of mortgages in India. All right, so you've got your mortgage, keys in hand. Time to live happily ever after, right? Well, hold your horses, or your legally binding documents. Because taking on a mortgage isn't all sunshine and freshly painted walls. There are risks. Big, scary, keep-you-up-at-night risks. Losing your job is a big one. Suddenly, that monthly payment isn't just a number. It's a looming monster threatening to eat your house. Then there's negative equity, a truly joyous concept. This happens when the value of your house falls. Yes, house prices don't always go up. Shocking, I know. So you owe the bank more than your house is currently worth. You're trapped. Can't sell without owing the bank a fortune. Can't move. You're basically married to a depreciating asset. It's like buying a fancy car that immediately loses half its value, but you still have to polish it every Sunday. Interest rate hikes. We touched on this. If you're on a variable rate or your fixed rate ends, your payments can suddenly shoot up massively. Your carefully planned budget, shredded. Your dreams of a holiday, now a dream of affording bread. It can happen quickly, unexpectedly, leaving you scrambling, stressed, and possibly facing repossession, which is a polite word for kicked out onto the street. And life just happens, doesn't it? Illness, divorce, unexpected giant repair bills. The roof could decide to become a sieve. The boiler could explode with the fury of 1,000 suns. These things cost money. Money you might not have because so much of it is going to the bank. A mortgage reduces your financial flexibility. It's a very expensive, very long-term ball and chain. Section 8. Is there life after or before mortgages? Alternatives and final rant. So, is this it? Are we all doomed to a life of mortgage servitude? Is the only way to own a home to sell your soul to a bank? Well, maybe not entirely. There are alternatives. They might not be easy, they might not be common, but they exist, like honest politicians, rare but rumored. One option, save up, a lot, for a very long time, live like a monk, eat beans, never go out. It's the hard way, the very, very, very hard way. Then there's shared ownership. You buy a share of the property, say 25% or 50%, and you pay rent on the rest to a housing association. It gets your foot on the ladder, a very wobbly ladder. With a landlord who is also sort of your co-owner, it can be complicated, and the rent can go up, but it's an option if you like complicated and potentially still paying rent. What about getting help from family? The bank of mom and dad. If your parents are loaded, congratulations, you've won the lottery. For the rest of us, this isn't always an option, or it comes with its own set of awkward family dinners. There are also things like housing cooperatives or even, dare I say it, building your own tiny home. If you're handy and don't mind living in a space the size of a large cupboard, these are niche, but they show people are trying to escape the system. So, are mortgages a scam? A necessary evil? Well, they're certainly a massive profit engine for banks. They lock you in for decades. They come with risks, but for many, they're still the only path to owning a home. The system is kind of rigged, yes. But until we invent houses that build themselves for free, or convince billionaires to just give us their spare mansions, mortgages in some form are likely here to stay. Just go in with your eyes open, very, very wide open, and maybe a helmet, and